All right, guys. VOO in the last 3 years has a return of 23.13%. Not bad. Then SPMO, the Invesco S&P 500 Momentum ETF, 3-year return, 30.26%. That's amazing. But then AOTG, the AOT Growth and Innovation ETF, has a 3-year return of 36.68%. So what are we going to do? We're going to talk to John Tinsman, CEO and fund manager at AOT Invest, the creator of AOTG. John, thank you for being here. I appreciate it. I'm super excited. I've done a lot of research into your fund, but let's just break it down from the beginning. Let's talk about the fund structure, how you're approaching this. I'm excited about this. This is one of the coolest things I've seen in a while. So let's jump right into it. Thanks for being here.
Thank you for having me. I'm very excited to be here as well.
So what is your general investment thesis when you created AOTG? Let's start there, because I think people want to, let's describe the differences between this and a VOO and a SPMO, because this is a growth index fund. This is perfect for index investors.
Yeah. So my general thesis was do what's done the best historically, right? And I also like to call that common sense. But my general thesis was buy low marginal cost businesses that had high growth. Okay, so low marginal cost is the cost to produce one additional unit of good. I like to give the example of Microsoft. So if you go and download one Microsoft Office, that costs Microsoft nothing to produce. It's 100% profit margin. All right. And so because it has 100% profit margins on additional sales, one, it reaches very high levels of profitability. That's great for investors. Two, it can scale without debt, right? So making additional units costs nothing. So it can scale very quickly to meet demand. That means it can be much higher growth. That's also very good for investors. And because it has no debt, it also lowers the risk for investors. Another good thing. The third thing is that because they have such high free cash flow, they can innovate, I think, at like rates of 100 times faster than traditional companies. And so when you have that high of level of innovation, that inevitably creates value, one, for the consumers, but two, also for the value of the company itself, because they're making better products and serving more customers. So I believe the mathematics is like quite obvious that these investments, this type of company not only has lower risk, in my opinion, but so many multitudes higher upside. And like you guys, like just use some, like think about it. Like how much has Apple gone up in 10 years versus the S&P 500? What about Visa? Yeah, I think like over the 15 years, right? Like Nvidia's up 50,000%, Apple's up 5,000%, Microsoft's up 3,000%, Google's up 3,000%. So look, I'm not like cherry picking them. Those were some of the biggest low marginal cost companies 15 years ago. At the same time, the S&P 500 in the last, 15 years is up 200-300%. So, you're just talking about such enormous outperformance by many, many multitudes. And then you can think about like the traditional companies, like some of the namesakes would be like Ford or Boeing or 3M or Procter & Gamble. These companies as a whole haven't really gone up more than 100% in 15 years. So like, why as an investor today would you go and buy high marginal cost businesses for a very low expected return on a yearly basis when you could invest in what has like one, the most scalable, most profitable, lowest debt businesses around, which have very proven historically to be the best performers in a portfolio. So my theory was, and by the way, like think about this, like the NASDAQ has beaten the S&P 500 over 15 years. The tech index has beaten the NASDAQ. The growth index has beaten the S&P 500 as well. I found that there was almost a one-to-one, like a correlation of one based on the proportion of low marginal cost businesses in a portfolio and then the performance of the portfolio. So to me, it's like, well, what if I just make a portfolio that has all low marginal cost businesses and then even further improve upon their performance by focusing on the highest growth businesses with the lowest marginal cost. And the reason why high growth is important in this is because what's it matter if a company has 100% profit margins on additional sales if there's no additional sales, right? So it doesn't matter at all then. So you really want the company with the most additional sales. These are companies like Micron, Robinhood, right? 100% year over year revenue growth. And AppLovin. And think about it. Like those companies with the highest growth have been the highest performers in the stock market last year. So AOTG is out there. It's done very well for investors. And I'm happy to be here to share like the strategy with you guys today.
Okay, I saw AppLovin as one of your holdings, and that's when I went, what is going on with this guy? Because I bought AppLovin. I bought AppLovin in 2023-ish. around there before it exploded. But I came from advertising and I used app loving in apps, right? Because it helps you for mobile advertising. So I was hyper aware of it. But when I saw you were putting that in your fund, I'm like, what is going on? This guy's he's seeing the right things. And that's what got me really excited was the app loving example. But then what do you say to people? And this, I guess it was come down to like how often you're rebalancing this fund, but people who go, we're in a tech bubble, AI bubble, a lot of those low marginal cost companies, they go are whatever, they're overvalued.
Yeah.
Who is like, there's all those common arguments. What do you say to that? And, what kind of investor is this for? Because there is some risk associated with this because they are technically, I guess, higher risk
Yeah, I mean, I find that
companies.
the risk metrics, like think about this, like you have AOTG and it
Yeah.
goes up, 25% uh in 2025, and then you have like the S&P 500 and like that index goes up by like 16% in 2025. Which one had higher volatility and higher standard deviation? Like quite
Yeah.
obviously the one that like moved more from this like from the beginning. So I find the traditional metrics I think sometimes like a little ridiculous. Like nobody looks at the volatility of their portfolio on a day to day. Like what people usually care when they invest long term is like, what about over 2 and 3 years? And to me, when you have a company like AppLovin that's growing their revenue at 70 something percent year over year, I mean, imagine compounding that for 3 years in a row. Like, it doesn't really matter if they have a price to sales of, like say, if they have a price to sales of like 20, because in 3 years, if their stock price didn't go up at all, they would have, I mean, they're compounding it annually. So you'd be like over tripling it. So it would be very unlikely to see a company like that have their price to sales fall by over a third. You know what I mean? I'm sorry, like, yeah, basically be cut and go down 66%. So I find in the long run, there's a lot of safety in companies that are earning more, right? And so when you have a company that's earning 150% more than a year before, then like if the stock doesn't go up, the PE ratio just dropped like a rock. And if the stock goes down, the PE ratio looks like it fell off a cliff. So like it becomes even a better investment. And so people start buying it. And also these companies, because they're earning more, start doing more buybacks. And it really creates a floor on the price. And then eventually I think these companies go up and they go up I think in the long run, how much a company earns is very strongly correlated to the price. So if you have the best earnings growth in the market, then you would think that that's one of the safest things you could do long term, in my opinion. And then like the way the low marginal cost helps with that is you get a company like AppLovin and they have 70% revenue growth, but we know that like each additional increments of sales, the advertising sales, costs them nothing. So what's
Yeah.
so what's like the earnings growth? And the earnings growth often is multitudes higher, right? I mean, so we see these software companies like growing like Toast 450% earnings growth year over year. And so basically, like you get the revenue benefit, but then you get multitudes of that on the earnings side. And so you think like this is a portfolio that has the potential to go up very high amounts. And like AOTG went up in 2023, 54%, right? In 2024, 32 percentage points. In 2025, 25 percentage points. I mean, these are really high net levels, right? You were talking about a 3-year annualized return of 36%. You have to keep in mind that like Warren Buffett's historical rate of return was 21%. So it's like, this is good, right? And like, yes, anything that goes up a lot also has the potential to have some downward price discovery. So you're going to see some higher volatility associated with that. But I don't think that should stop you from investing when you're a long-term investor. I don't think most people are investing for like a week or a month. And then I would say the other thing I do to manage risk is I only focus on profitable companies. So, the criteria is to invest in profitable tech. And so a lot of people think of like the dot-com bubble, but they forget like the NASDAQ back then was like largely very unprofitable companies. And so it dropped very sharply. Same way as like there was like ARKK and that dropped very sharply in 2022, but it dropped multitudes more than like the information technology index or the growth index, right? So I think if you, focus on the most profitable companies and kind of skip the unprofitable ones, there's also a lot of room to improve upon the downside in versus like the leading indexes. And so the other thing that people say when I say I only focus on profitable companies is like a common thing is like, yeah, but then you missed like Amazon or like Facebook when they were unprofitable. And like, that's true. You missed them. but you were investing in Google and Microsoft, which went up just as much and didn't have nearly the downside potential. And for every Amazon and Facebook you buy that's highly unprofitable, there's also quite a few that just don't make it. So you kind of like almost you almost eliminate all the misses, but you keep the same upside or more on the table. And so that's like my theory there. And like, yes, there will be some like unprofitable companies you miss until they turn profitable. But eventually, you know, if they keep growing and they keep providing value, they will turn profitable, and then they'll be in the portfolio right away. So I think that's like the most, exciting thing about this strategy. And you could see like in 2022, a lot of things sold off like Robinhood. And once they turned profitable, like AOTG added them. And then we've ridden that appreciation back, I think like it really helps on the performance side.
How many I haven't checked this. How many holdings are in the fund? And then just to go over this one last time, the screening process is low marginal cost, which is almost always software companies. To give people an idea, I have my start in advertising was software. So the reason why I actually love the way you do stuff is you would invest the exact way I like to invest. You're doing everything was being done right. You're looking for low marginal cost companies that are profitable, revenue growth year over year. It's like those are the right checks. Did I miss anything there, or
No, I mean,
or is
I
there
can go
another
into the details
baseline
much
screening
more.
process?
So it's a lot
Let's
more
get into
nuanced than
a little
that,
bit
but
more
that's
detail.
like the 10,000
Yeah,
foot view and like very easy to
yeah,
understand for investors.
yeah.
And so like on the more nuanced view, I mainly focus on large cap businesses. So I don't actually focus on the small and mid cap. And I don't know if you've ever looked at like the Morningstar box, but you can see the large cap growth beats every other sector, right?
Uh-huh.
By a lot. Like it's not even like a little, it beats it by a lot. And you're like, why is that? Why, like, shouldn't the smallest companies have the most growth potential? Is I think what I hear people say. Like, I believe that this small company should have the potential to do better precisely because it is small. So it has more room to become big. And the
Yeah.
problem I see there is a lot of these software and tech companies in small cap have outrageous stock-based compensation. These companies some of them are giving they're basically have like stock-based compensation that's 30% of revenue each year. And so like imagine taking that much upside off the table every year and compounding that. So it's not that those small cap companies don't have that upside. It's just that the shareholders aren't, the ones I think historically that capture most of it. So I focus more on the large cap ones because these companies are doing the opposite. The people at Google are being paid just as much, which is crazy when you think about how much bigger Google is. But then they're doing buybacks. So instead of diluting the number of shares each year through stock-based compensation, they're actually, winnowing the number of shares each year. So they're concentrating your ownership. They're increasing in profitability. And you miss a lot, obviously, when you're not in the small cap space, you miss a lot of the unprofitable ones. And also, I think that their amount of cash flow that they have when they're big leaves so much room to invest in innovation that they have very large staying power, as we've seen. And so that's my focus on, large cap. Okay, so then once you get past large cap, you also need to screen for cyclical businesses. So basically, like there are software businesses that go straight up, like their revenue. You look on like Yahoo Finance and it's like 1 billion one year, then 2 billion, then 4 billion, then 8 billion. That's like a good thing to see. You want to miss the ones that are like 20 billion one year, then 10 billion the next year, but then 20 billion again the next year, because you could invest in that company that showed year over year strong earnings growth, but over 5 years, maybe it's nothing. And so you really want the long-term secular growth. And so there does needs to be some like manual checks on that and making some decisions. And sometimes it's hard in a company like Micron, which is in AOTG, because it seems like the long-term secular growth there is there. But also when you look back historically, it seems like the revenue's been somewhat cyclical. So there are some hard judgment calls that need to be made. And you try to do that for the benefit of the shareholders. Basically, when you do a rebalance, I have a lot of, and this is something that's hard to do in an index. And so like the leading indexes weight by market cap. And like when you actually like think about how crazy that is, like nobody would ever do that for their own money. Like you've got companies like Toast that have a price, which have more revenue and are more profitable, have a price to sales of 4. And then you have companies like Palantir that have a price to sales of over 100. And so like imagine going to a restaurant and like one charges a steakhouse, one charges like, $100 for a meal, and the other one charges $2,500, 25 times more for a meal, which is similar to the price to sales difference between Toast and Palantir. Imagine going into the restaurant and being like, you know what? I know I want to eat out, but for every one time we go to the $100 restaurant, why don't we go to the $2,500 restaurant 25 times? And like nobody chooses like to invest like that. Warren Buffett, if he had $1 billion, wouldn't be like, oh, I could pay $1 billion for this business, which is bigger, or 25 billion for the smaller one, and I'll buy 25x more of the more expensive one. So like, there's some really common sense improvements, and what that looks like in a rebalance really is when you rebalance, you're like Palantir used to be an AOTG, it's not in it anymore. Just because I
Okay.
can invest in higher growth businesses with lower valuation metrics, which I think is a long-term winning formula, and it's very common sense. Like I could actually show you like what a rebalance looks like and all the metrics, but it's really like a mathematical formula that's minimizing valuation metrics. So you're really trying to minimize the price to sales ratio and the PE ratio in a rebalance, and you're maximizing the revenue growth and the earnings growth. So you might have a company like Spotify, and I did this in August. I took Spotify out of the portfolio, right? It had a price to sales ratio of 8. It actually turned unprofitable, and the revenue growth was falling. And I think the revenue growth was like 8%. So I replaced it with Micron, which had a price to sales ratio of like 2 or 3. It had 175% earnings growth and like 60 or something percent revenue growth. So now you've got something with a PE ratio that was like 12. So like now you've got something with a PE ratio that's like 12 instead of 300. You've got something, and by the way, Spotify had a 600% rally from like 2022 AOTG's inception through like when I was, cutting the position. So basically like you're making just common sense moves of maximizing the revenue growth and earnings growth in the portfolio while minimizing the valuation metrics. And I think like at the end of the day, you make a portfolio, like if you compare it to other indexes that has higher revenue growth also and earnings growth, it has lower valuation metrics. And so I think that's like part of the long-term winning portfolio, or like the long-term winning like how can you lose if you do that in the long term? It seems like it stacks the odds in your favor enormously. And then like if you focus on just low marginal costs within that, it gives you, I think, even better probabilities of having great performance. So I mean, that's kind of the more nuanced view of it, Gary.
Before we move on from rebalancing, are you always just replacing positions to add new positions in? So you're taking out, you said Spotify, added in Micron, or
Yeah.
are you trimming some positions to add in new positions? Do you have a threshold of, we don't really want to go above this many positions? Like, how are you approaching that?
Yeah. Well, all right. So there's two things there, and I want to make sure I hit both of them. One of them is concentration, right? So how do you choose the
Okay.
right number of
Oh,
positions to concentrate in? Um, so that one basically, and all right, and then the next one is weighting. Okay, so are you eliminating? Or are you cutting? How are you coming up with a weight? So all right, so concentration first. So you want diversification in your portfolio, but you don't want diversification that raises risk and lowers returns, because like that's doesn't make any sense. Like you don't diversify to have more risk and lower returns. And so there's a certain point where it's like, hey, like I'm selling Google so I can have more positions, but these companies make less money, they have way less earnings growth, and they're way more volatile. And so like that's like not diversification I would want. Now, some investors I think maybe like to see that they have a lot more holdings, but I believe that you're best off if you concentrate in the best, highest quality companies that are earning the most, the fastest, right? So that's the first thing. And like I would just say like diversification that lowers returns and increases risk, like that's not smart in a portfolio. Now, I wouldn't just want to own the Mag 7. So I think there's like a really delicate balance there. To me, that 40 to 70 names that AOTG targets is the right way to do that. And we know that like the best gains are actually concentrated in the biggest companies for like the reasons I already went back on, like basically lower stock-based compensation, better like scalability, but and more innovation. And so like if you include too many names, you're also decreasing the market cap, which historically like the data suggests that really could meaningfully lower returns. So when I make these decisions, it's really data-based and looking at all the data, running the back tests and saying, what do I think will carry, like these reasons that it did better in the past, which ones of these will carry forward into the future, right? And so I make those decisions, and I think like each one of them is very deliberate, and like I invest like almost all of my own money in AOTG and now AOTS. So like I really do that from like a what's the right amount of concentration. The next question was weighting. And so the first thing is when you have an ETF, you have to follow the diversification rules of you can't be too concentrated in certain ETFs. So part of rebalances is actually trimming the winner. So like I had to but I had to reduce the weight of Robinhood at the last rebalance precisely because it's gone up so much. Same thing with NVIDIA. NVIDIA has gone up thousands of percent since inception. So this has been a name I've been having to consistently trim, though I am overweight it versus the indexes, right? And so that's been true for Google. It's been true for Microsoft. And so you have to maintain diversification requirements within a portfolio. By the way, like the NASDAQ and stuff, like the NASDAQ 100, the QQQ, they also do that. So there was points when they were also trimming NVIDIA because the market cap had gotten too big and the portfolio was becoming too concentrated versus the SEC rules. So like that's true for, all long only equity portfolio ETFs, even the indexes. And their index committees will reweight stuff based on what the rules are. And the other part of that is deciding, hey, how do I play around with the weights to, I think, give the portfolio the best chance to outperform? So the weighting is discretionary, right? And now I weight by high earnings growth and high revenue growth. So I don't focus on market cap because I don't think that makes any sense. When investors buy a growth portfolio, they want the highest growth in the market. So instead of having Apple, which is barely growing, as the biggest weight, like you see in a lot of growth portfolios, you end up with the top weights, some of them being like AppLovin and Microsoft. I'm sorry, not Microsoft, AppLovin and Robinhood and names like that, which are growing. Like when you think about it, if you've got one growing at 5% a year and the other one growing at 100% a year, it's growing 25x or 25 or 20x more. So like you're creating a portfolio with enormously higher growth metrics. And I think that's what investors want when they invest in growth. And it's what I certainly want when I want to invest in growth. So to me, I think that's a pretty common sense way to go about an active growth portfolio, which you just don't see in indexes.
A lot of people watching this interview will be thinking, like, holy shit, this CEO really knows his stuff about how to manage a fund. He looks like he really cares about this fund. Kind of rare for a CEO to be this involved, care this much, have this much information just sitting, like the way you're talking about it, it's like you really know your stuff. That's what got me interested in this, because I saw your interviews with Marcos Mila and I saw a bunch of your stuff and I understood why. Because you created this for yourself. You ever worry that, hey, no one cares about the fund you bought in and they don't have skin in the game? This is the exact opposite of that. And I think this is why I like it a lot. Can you walk us through exactly how AOTG got created, your rationale behind it? And it'll click for a lot of people like it did for me, like, oh, that's why he knows the inner workings of everything he's talking about. That's why he's so passionate about this, because people need to know that. I think a lot of, especially in Canada, retail investors want to feel like where we're putting their money, someone else actually has something on the line too. We're not just holding the bag when things go wrong. It's, where someone else actually has a vested interest in this. That really got me interested in you, the company itself, the fund, just because I felt like, all right, this guy's going to do what's best for it, even if it's selfishly, because he wants to make money. He needs a fund to perform well. Talk to me about that process, how you came up with AOTG, the rationale behind it, all that, the story. I want the story behind it, essentially.
All right. So I've been doing this my whole investment career. I've worked at family offices. I've worked at institutional trading companies doing market making. And then I came back that whole time I was always investing myself and for my family. So when I was in high school, I started to invest for myself and for my family. And I did have that, I had that stance towards growth, investing in companies like Apple and Microsoft and Visa. My dad at the same time really liked value. And why would you pay for something that has a PE ratio of 30 when you could buy one for 10? But it kept showing year after year after year, you're just like crushing the performance of the value fund. Like a lot of value funds didn't go up last year and AOTG went up 25%. So it was very clear that the performance was there historically. Eventually my brothers and my dad and my mom all wanted to have me manage their investment as well. I went to Northwestern, I studied economics, and then I went to University of Oxford as well and studied economics and management there. So I've really been focused on this for a very long time, right? I'm 32 years old now. One of the last videos I did, the people were like, John, stop saying you've been doing this since high school because it looks like that was yesterday. So it wasn't yesterday. It's
That
at
was my
least
question. I was
14
gonna be like,
years.
how old are you, man? You look very young. That's why I said
Yeah.
you look very young.
Yeah. So 32, blessed with 4 kids now. So I guess I feel older than I look.
Yeah,
but so
you're busy.
so eventually the amount I was managing, right? You guys know, like since 20, since 2011, even like the tech index is up 2000%. So eventually the amount I was managing grew to be a very large amount. Now, when you do this in brokerage accounts, when you sell something, you have to recognize capital gains on it. And that really eats into the performance. You could be cutting, the performance by 20% every year. And once you consider the after-tax implications, maybe quite a bit more, right? So eventually I converted this strategy into an ETF for myself and my family. Because we wanted to allow the gains of our proceeds. And an ETF, basically, for those that didn't know this, can sell shares of appreciated assets like Spotify or Nvidia without recognizing any capital gains for the shareholders. So then, like, let's just say the fund's like saving a couple $1,000,000 a year for shareholders. Then those shareholders have a couple $1,000,000 that stay in the market and continue to appreciate. So over a decade, that couple $1,000,000 could grow to be tens of millions of dollars, and that's recognized every single year. So ETFs are very good for investors. I converted doing this strategy for myself and my family into the ETF model. We continue to own the majority of the shares outstanding in AOTG. So we put in Iowa where I'm at, people say you bet the farm on it. So we bet the farm on this. I feel very convinced, and I'm here to do this because I believe it's the right thing to do, the right way to invest that maximizes returns and lowers, risk. I'm not really here to a lot of people in the ETF industry, I think, are on they're mercenaries, right? Like they're there to sell their funds and make the fees. But I'm here to focus on the investment management and have the best possible returns. The fees is really not really like the main or even side consideration for me. But just basically trying to have a business that can, break even on like the operation side, but then we can all capture the capital appreciation in a tax efficient way for myself and my family. So I believe in this strategy, and I'm going to be here doing this, for a long time.
Yeah, my brain when I heard your story and I was trying to read up more about you, I was like, oh, so I'm investing. I know I probably shouldn't say I'm investing in the Tinsman family fund. It's like these guys and what they're doing over there. That's just kind of how it felt. And then could you look at your management fee expense ratio, 0.75%, some back and forth about that online. But then, when I crunched the numbers, I'm like, he's not making money off of this. Like you're essentially you're working for free. You're just trying to get this to be the highest performing fund on the planet. So that's like, now I get it. You need this thing to perform super well. Anyone else who sees what you're doing, like a guy like me, a guy like Marcos, go, oh yeah, cool, this is great. He shares the exact same investment thesis that we do. He's approaching this the same way we do. We like software, we like low marginal companies as well. We like high profitability. Maybe we can deal with those swings a little bit because you do get swings up and down when you're dealing with tech and all that kind of stuff, whatever. We're okay with that. Like there's stuff that we like and it's like, okay, great. That's on board. And you're younger than me, which is nice. So you have more energy for this, even though you have 4 kids, right? So like you have the energy to keep this up, right? Yeah, I guess that was important for people to know. But you want to talk about that expense ratio because that was really when I was reading online. I was telling you I went through every comment I could find. I've seen a lot of interviews. Guys, check out his interview with Marcos Mila. Marcos has the ETF. He's an ETF centric US based YouTube show. He's been on our podcast. He's fantastic. But you did 2-3 interviews with him where you get into the weeds about everything. And when I was going through the comments, very hard to give you pushback because there is no sales. There is no you trying to hawk a product. There's just you providing the education. You're forthcoming of like, yeah, we invest our own money into it. Your thesis is on point, especially for guys younger than me. I'm 40, but even for me, because I came in from software, I like it. Only pushback I got was the 0.75%. They go, hey, why don't I use a momentum ETF like SPMO? But there's a stark difference between a momentum ETF like SPMO and you. Can you talk about that difference between momentum, which just tracks price movement, and
Yeah.
then explain the expense ratio stuff? So now
Yeah.
we can shut that out so I don't get those comments.
Yeah. So the first comment on momentum. So what I often find is that there's time periods where the investors want to compare, the fund to something. And because the fund's like one of the top performing funds, they try to find anything else that's like the top performing fund and compare it to that. So SPIMO is a fund that's done very well. And it invests in momentum. Momentum means like it looks at like how much the stocks have gone up in the last year. Okay. So there's no fundamental analysis on that. It's simply like, what was the price last year? What is it today? Now we're going to do a rebalance. SPIMO also rebalances once a year, so they don't have to trim their winners very often. Like they have to meet their diversification requirements yearly. So it actually allows, one of the reasons why it's done so well is because it's allowed some of those companies like Nvidia to be the biggest, but continue to run for a long time without being trimmed quarterly, like even the NASDAQ had to do. All right. So like SPIMO, that's just, like the last 3 years, that's one of the reasons why it is like one of the top ones. It's because it does very frequent rebalances. Or maybe it's every 6 months, but it's less frequent than most other funds. So it's allowed the winners, some of the big winners, to ride a little longer. Now, AOTG only looks at like earnings growth, revenue growth, low marginal cost abilities. So like I've never considered how much a stock has gone up or down over the last year. So it's not at all like SPIMO in any way. So totally different strategies. I would say that there's some overlap between what's gone up the most and what's had the highest earnings growth, right? So if we know that earnings growth is strongly correlated with what goes up the most, well, then we know that when you focus on what goes up the most, you probably get some of the best earnings growth as well. So they're very different strategies, but the things they target can lead to some overlap. So that's the first thing. But like sometimes when tech does really well, AOTG gets compared to tech. But like AOTG is only 55% information technology, similar actually to the NASDAQ. So like it's really not a tech fund, it's a large cap growth fund. And like Robinhood, Visa, like these are all top holdings. Google, Amazon, none of those are in the information technology index, right? So this is broader than information technology, though I do think it is common sense tech. When you buy a tech fund, I don't think it includes common sense tech most of the time. So so that's just those two differences right there. Then on the fee side, okay, so the next thing is you want to compare a fund that is 3.5 years old and has $100 million of assets or around there to a fund like, the Vanguard Growth Index or like the SPIMO. And these are funds that, have hundreds of billions of dollars of assets. And so like it hasn't reached the scale. Okay. These funds started a long time ago. If AOTG someday had that many in assets, the fee would be very low as well. But you have to keep in mind, these funds these are passive indexes. So there's not like a human factor in them. And so when I started AOTG 3.5 years ago, I tried to look at like, what are the other, look, I knew I was going to lose money for a long time on like operating the business side, right? So like the business costs more than it makes in fees. So for the past 3.5 years, when you look at it that way, like I haven't paid myself anything for 3.5 years. The way I'm making money on this is through the investment in the fund, and my shares continue to appreciate just like any of your guys's when you buy it. And the performance, by the way, when you look at it, is always after fees. So when you're looking at that and you're throwing it up on the chart, that's always after fees. The active funds that I think about, when I compared it, and there wasn't 3.5 years ago, there really was not that many active growth ETFs like that out in the market. So I even had to look at some more mutual funds, but it was actually the lowest fund of any fund I was comparing it to, whether that was ARKK. And now there's newer ones that have come out like Granny Fund Shots and the Dan Ives Fund and stuff. And none of those funds have a lower expense ratio, and all of them have multitudes higher assets. So when you look at it that way, it really has a very low fee for its size. And also for just to compare it against other active funds. So active funds are always going to be different than market cap based indexes, which are much cheaper and automated, right? But when you buy a market cap based index, you don't really have any opportunity to outperform. You're kind of matching that sector that you're investing in. So if investors want that opportunity and they say, hey, this one's outperformed the last 3.5 years, I believe this strategy, when I think about it, probably has done that historically for a long time. And I want to buy in this fund because I think it gives me the best opportunity to continue to outperform. Then like you end up going down that active management route, because if you believe weighting by these factors the way I weight is the best way to do it, then you basically fall into an active category. And you incur higher fees, but like I said, the fees are not as much as it costs to operate actually the ETF business. So I try to keep things very reasonable, but I do hope like when AOTG is larger to lower the fees, and like I would be right there next to investors saving money on it. So I'm 100% on the side of the investors, and I think they're right to always consider the fee. And just right up front, it's 75 bips. So there you have it.
Yeah, I'll squash it a little bit more on the fee because I've looked into how to set up an ETF in Canada and I've looked at the fees associated with it.
Yeah.
It's not cheap. It is not cheap. And when you look at your assets under management, it's very clear when I was looking at it, you were aiming for break even. It was like, oh, okay. And the reason why you are still cheaper than everyone else is because they're not aiming for break even. They're aiming for high profitability on
Yeah.
top. So you just found a number that's like, it's very reasonable. So for me, just looking at how much it costs to set up an ETF in Canada and whatnot, I went, oh, whoa, okay, this guy's all right, cool, good on him. It's more of I guess showcases a little bit more about character side on your side. I go, oh, okay, he's in it for the right reasons. That's what I got from
Yeah.
it when I was looking at the financials.
Yeah. And I
So
am. Thank you.
yeah, that's very, very clear. Another thing, and this for me, someone said, oh, it's not liquid enough. It's been around for 3 years, and the assets under management are, I think you can quote me if I'm wrong, they've doubled in the last year or so. And it's not I don't know, Tom, why someone would care so much about a fund that's been around for 3.5 years, how liquid it is. Isn't this a buy and hold? It's a
Yeah,
growth
well, I
ETF.
think it's like a really big misconception around ETFs too. And by the way, I love to
Yeah,
talk about this stuff because like the
yeah,
more things you can talk about in ETFs, like it doesn't just apply to AOTG, it applies to like all
yeah,
ETFs. So hopefully they can take that knowledge and apply it and be better investors. So ETFs are not like a closed-end fund. So they think because there's only like say a couple million shares outstanding. Well, if somebody goes in and buys a million shares, they'll spike the price. You know what I mean? Like, oh, like who will come up with all those shares when there's not even that many shares out there? Um, that's the theory. And that's would
yeah,
happen in a really like micro penny stock, right? Like that didn't like say there's barely any shares and somebody goes and tries to buy a bunch, like well, there'd be no one to
yeah,
sell them, so they'd spike the price. That's not how ETFs work. ETFs have market makers that are created and redeemed on the spot. So like when Gary goes to buy, $1 million of an ETF, he's not somebody that already owns it doesn't have to sell it to him. He goes and he puts his money and the market maker usually sells it extremely close to the net asset value where it's trading that second, right? So it calculates the price of every single, name in the basket and then the weight and says this is how much it should cost per share. And they generally, I think, try to sell it to you extremely close to the net asset value. And then those shares are created just for you. And so the market maker takes that money, it buys the underlying stocks and it deposits it into the trust, which is the ETF. So now you own shares of the trust. Like the underlying companies were all deposited into the trust, and the trust issued back the shares the market maker had sold to you to the market maker. So it is all automated by software. It happens in a flick of a second. And it's extremely efficient and good for investors. I think it's why I think ETFs are one of the reasons why they're growing so much faster than mutual funds. When you buy a mutual fund, like the fund manager gets the cash and now he has to go and place all these trades and generate transaction costs and stuff. This is way lower expenses, way easier, better for investors. And you could have an ETF with $1 million of assets and somebody could go buy $100 million that day and it probably would get filled like right close, like right next to the net asset value, like any other ETF. They'd just be created for that shareholder. So I'm not concerned about liquidity in any way, even in ETFs that are much smaller than AOTG. I would just say though, I always use market orders. I'm sorry. Gosh, I always use limit orders. All right. So like I'll look at the bid ask spread and set the limit at the ask if I'm going to buy, or if I'm selling, I'll set the limit at the bid. Right. So I always use limit orders. And I think that's actually preferable when you trade any security. Now, maybe you don't have to in NVIDIA or Google, but I do think it's like
yeah.
good practice to do that. And that's what I do myself. So that's what I would say about those two things. But the liquidity side, I don't think matters in the way it would with a closed-end fund or a micro cap stock.
There's a couple unique things about this fund, and I was trying to think through it exactly how Canadians could leverage just the structure of this, where it's lower dividends from this fund. Which because we have the 15% withholding tax on dividends on U.S. Stocks, any distributions of dividends that come from them. But because there's little to no that come from this fund, is purely growth focused, it sort of opened it up to where we can place it in which accounts. So we have a tax-free savings account, right, where we pay no taxes on anything. We just withdraw and we get tax-free. RSP, tax deferred. We can deposit deferred taxes, and when we withdraw, it's treated as income. And then non-registered, where it's just taxed, depending on what kind of thing it is. Is it a dividend? Is it capital gains? Whatever it is. But because this is just pure capital gains when you sell, you can kind of place it anywhere. I guess for Canadians, it's similar to whether or not they decide to buy VOO, because VOO, they decide, hey, do I have US currency I want to use, or do I mind doing the US conversion from Canadian to US? I feel like that's really the only obstacle for Canadians on this. But unlike VOO, I think I have to look into this a bit more. It doesn't have the 15% withholding problem because you're not collecting anything. Everything just being share buy back in. Everything is just continuing to grow. I know you probably haven't thought about that too much because you deal with Americans
No, I do. I
a
think
lot. But
about
what
it
do
a
you?
lot.
Well, okay. Do you? Okay. What do you think about, like? Did what I say kind of make sense as far as like
So
how I'm
I
sort
don't
of thinking
know
how
the
we can use it?
Canadian tax side of it, but I know the
Yeah,
American
that's what I
side.
meant.
Uh,
Yeah.
on the American side, capital gain or dividends get taxed at ordinary income, which for people like me could end up being almost 50%, right? So much
Yeah.
higher than the Canadians. And so it was really important to me to create a fund that was extremely tax efficient, because the tax drag on portfolios, I mean, imagine even a portfolio that is a 3% dividend, but you're paying a 50% tax. It lowers the performance by 1.5% then after, if you're reinvesting after you pay the tax. 1.5% annualized is enormous, right? Especially when you do it
Yeah.
for decades. So what I really focus on is the companies that are doing buybacks instead of dividends. And
Yeah.
buybacks push up the value of the shares. And then if you ever want a distribution, you just sell, you'd sell a small number of AOTG, and you'd be recognizing in the US, you'd be recognizing long-term capital gains instead of ordinary income. So it really reduces the tax drag. But then, of course, you don't want to recognize any taxes if you don't have to. So like you're really being able to delay taxes and defer that until the last possible moment when you actually want the money, instead of having to recognize it every quarter or whatever and pay taxes every quarter. So it's very tax efficient. What I would say to dividend investors is I target companies with the highest return on capital invested, right? And companies that are achieving incredible rates of return on their capital invested, the shareholders tell them, don't pay a dividend, keep reinvesting it into the business and keep generating great returns for us and value. The companies with the lowest or even negative return on capital invested, shareholders say, whoa. And by the way, return on capital invested is correlated to stock market returns as well. So these companies with negative return on capital invested, the shareholders say, you better give me that dividend because I don't want you burning it in your company. And
Yeah.
when you target companies that are having the worst return on capital invested, you're inherently lowering the value of of companies that won't probably perform as well because in the long run. And so you do see the dividend funds significantly lag. And so I'd really encourage dividend investors, if they're not like paying their bills with a dividend, but they're trying to reinvest it, to really focus on, I think some more growth names. And being able to keep that capital appreciating in the market without recognizing taxes, it's mathematically, it's a winning formula. Now, there are some dividends that go into AOTG, but like any ETF, if they offset the expense ratio before they're paid out. So because the dividends are very small, AOTG's never paid out dividend distribution yet. I'll say there. But the interesting thing now that we're on value, if you don't mind, is value businesses are traditional businesses. And so they're mature, right? And I will give you the story of my own family, right? So we operate a fertilizer company in Iowa that sells fertilizer across the Midwest. So we manufacture it and we sell it to businesses and we sell it directly to farmers. This is like any value business, okay? It has a very low profit margin, right? And this is the same whether you're building airplanes or you're building cars. To scale the business requires immense amount of debt, right? Because you're like, oh, we want to go enter a new market. Well, you need a new factory. You need, 20 new retail facilities, and that bill is going to be $500 million. And, that's very risky. So maybe you have like an 8% interest rate, but you can see, and then you say, okay, well, now we've done all that. We've got the debt. How do we win the business? Because somebody's already selling fertilizer in those areas, right? Like we're going to go into Canada and steal all the business from somebody, like over somebody else's dead body. And that's exactly how
Yeah.
it works. They say, oh, you're not going to lose the business. So it becomes a knife fight, and you end up selling at very negative profit margins. So now you'd invested all this money for growth only to sell at a loss, and sell at a loss for a long time. And it's what do you think that does for shareholders? Like there's no profits, there's only losses, there's high interest rates. So like basically it like totally destroys value. And so what you get instead in these value-oriented businesses, hey, let's just sit here in our territory. In a knife fight, everybody gets stabbed and bleeds out and dies. So why don't we just not get into any fights with anybody, and let's be just happy with this little territory we have? And, like Ford's not going to, like Toyota's not going to hand the business to Ford. Airbus isn't going to hand the business to Boeing. What they end up doing is just cementing their own little territories, their own little niches, and they try not to get into fights with anybody else because it's extremely damaging for the value of the business. And so when you think about that now it's an anti-growth mentality. So we aren't going to grow. We're just going to be the same. And so why do you think these companies haven't grown at all in 10 years? Well, they're really making no effort to grow because growth actually destroys value. And so like me coming in and you, Gary, when you invest, we know to make money over a decade, we need to invest in companies that are going to be bigger in 10 years, right? Mm-hmm. And so why would I go buy the S&P 500 if I think half of the companies in it fall into that exact category I just talked about? Like, well, why wouldn't I just buy the other half of the companies that don't fall into that category and maybe double the performance? That's like the whole point. And I've seen it in practice. I'm still involved in the management of my family business, right? So like, I know it to be true. I'm very aware of what it takes to run a high marginal cost business. And it's not that I don't love those businesses, but I really think to generate wealth in the long term, you need to have businesses that are, creating their own sector. It's not ultra competitive. It's not a knife fight where it's really hard to grow and you risk getting stabbed. But instead, you're creating this new sector, you're innovating, you're providing new markets and products that have never been in the market before. And you can sell at very high profit margins. You can scale across the world for no debt. And you can reach, you can reach levels of profitability that are like 70%. Like, what is AppLovin's level of profitability? I think it's like insane. And same with like Visa, right? And same with Microsoft. Yeah. And these other businesses, you can put in all that investment and you still just have a 1% profit margin or 2%. So some people sometimes look at Costco and they say, well, Costco has a price to sales of, 1, but it must be a lot cheaper than Visa. So, Costco has a profit margin of 1% and Visa has a profit margin of 50%. Of course, Visa's price to sales should be much higher because it's capturing 50x more, 50x more profitability per sale. So like it's, each sale is like 50 times more valuable. So I would, as people sit there, and a lot of people naturally want to gravitate towards what looks the cheapest. It's just things to keep in mind and things I've learned over the years.
I think there's a lot of psychology that goes into it. I feel like this would be a harder sell on a much older investor who'd be like, no, we need something brick and mortar, something stable. That technology seems a little bit too flaky, where people under a certain age are like, what are you talking about? Right? Because I just feel like there's some, I don't know, it's just ingrained way of investing for older investors where they just can't get away from that. It's just too hard. Maybe it just feels they're standing on uneven ground a bit. But when you have something brick and mortar, even though the margins are worse,
like you can feel it with your
it's like that's a tangent. That's what it is. So it's less about profitability, less about what gives you the highest return. It's more about just that familiar feeling of things you can trust. So it's that you're not even talking about investing anymore. You're talking about emotions, feelings, stuff like that. Yeah. I feel like because coming from my advertising background, and I've worked with brick and mortar companies and I've worked with tons of software companies, the margins aren't even comparable. A software company can launch a new product, test it, find out it doesn't work that week, don't do anything with it, or the same week, test it, get some traction, scale it to hell, and then just keep scaling infinitely because the operating costs are so low. The margins are so fantastic where you could never do that with something brick and mortar. If you have a clothing company, you got to produce a t-shirt, you got to manufacture it, sell it, put it in a store, or even an e-commerce shop. But with something that's an actual digital product, it's insane. It's insane. That's why I've always sort of fallen into that area for
Yeah.
my investing as well,
And
just because
it's,
I understand it and I understand the margins.
yeah, I mean, so like you and I understand it. Like I understand it exceptionally well because I'm in both categories, right? And like I have an ETF company where additional
Mhm.
sales can come at no cost. And you have a YouTube show where you could add 10,000 subscribers tomorrow and your costs are go up zero, right? Like they don't go up at all. And
Yeah.
meanwhile, you have somebody that has a coffee
Yeah.
shop, and if they want to double their sales, they have to go build another coffee shop and incur debt, and then they have to hire and they have to train a workforce, and doubling the sales is extremely hard. It's time intensive, it's money intensive, whereas if the demand for our products exists, it comes at no additional cost. So like mathematically our businesses have a lot more upside. Like there's no way to argue it. And so and it also can scale much faster. All it takes is for the demand to be there to scale. And so like you want to invest as an investor in companies that mathematically have a higher probability of having a great payoff. And that's just like it exists in R2 businesses, it exists in the large cap stock market as well. And
I
there's
want to
no
talk
other funds,
about
by
this
the
is
way.
kind of
There's no other funds
yeah.
in the whole market that I'm aware of that focus on in the whole like world market that focus on low marginal cost. And that blew me away. And it's like obviously
That
what led
that
me
that
to
was a
starting
crazy thing. That
AOTG.
yeah.
But it's the number one factor
That's what I
I
was looking
find in
at.
my
That was
research to be correlated with great performance. And it just that no fund focused on it.
That's what I found weird when I was doing research on you and the company. I was like, oh, is no one else doing this? You ever see those ideas? Like
Yeah.
it seems like such a common sense idea. Everyone else
And
should be
I go
doing
and
it.
I sell it
That's
to
what I got. I
people.
go like, yeah.
I go and
Yeah,
sell it
yeah.
to people and they
It
say,
seems
"Oh, I'm
like it
sure there's
seems
like a ton of other funds doing this. What other funds are doing this?" And I'm like, oh, that I'm aware of none. And they're like, that's not true. That can't
yeah.
possibly be true. And it's like, well, I've really looked pretty hard. So
Yeah, I was looking before our meeting and I was like, oh, maybe I'm missing something here. Why? Like other people got to be doing this and nobody was because it seems like such common sense.
yeah,
I want to talk a little bit about good margins because a lot of people talk about AI and how AI is going to do a lot of layoffs and all that kind of stuff. But then people don't understand. And then they go like, oh, these companies are just, a lot of these tech companies are just increasing their share price so much. It's like, how can they keep up their profitability? Well, my company's called Thrive AI Corporation. We call that for a reason because we do AI, we help implement AI into companies. They don't understand how that affects margins, how much productivity, more work, how fast you can get a product to a consumer now because of AI. And it's just exploding the margins across the board. So AI has actually been an accelerator of creating way better margins, especially for companies within tech. You want to talk a little bit about that as well, just like AI and its effect on these companies? A lot of
yeah,
them are leveraging AI, the ones that you invest in.
yeah. So when you really think about what AI has the ability to do, I think we can all agree it can do two things. One, it can lower costs to make products, right? So you needed 100 software developers to make something. Maybe today you could do it with 10. And then maybe they're using AI to write a lot of the code, but they're double checking it, they're improving it, they're testing things faster. So all right. We know that lower costs are associated with higher profitability. So we know that's great for investors, especially for software companies that are going to be able to use these tools and lower costs. And we did, by the way, we did see a lot of layoffs at companies like Google and Microsoft and Amazon. So we do know they're already using those tools to lower their costs. The next thing is we know that they can innovate faster, right? So faster innovation, especially in that digital realm, just means more value for people and better returns for shareholders. So if you're innovating faster, you should have better returns over the long period of time. If you're lowering costs, you should have more profitability, which leads to higher returns over a long period of time. So like the tech index, right? And I hate to say the tech index because like I said, it's unnecessarily concentrated and excludes half of what it should. But like the tech index has gone up, I think at like over 20% annualized for the last decade. And what if the next decade's even better? You know what I mean? Like this sector is even better because of
Mhm.
those reasons. And a lot of people say, well, how could it look any like it's gone up too much? But when you think about the landscape of where we sit today and where we sat 10 years ago, everything looks better today than it did 10 years ago. And so I am extremely optimistic. And I think that the next decade has the potential to create even better returns than the past, which I think might have been some of the highest ever seen by a single sector in the history of investments. So, yeah, very optimistic. And I think I'm one of those people that's betting that it's going to continue, because at the end of the day, it's going to follow the earnings growth. And the companies like even like Google, 50% earnings growth year over year. That's enormous amounts for a company as big as Google. And clearly things right now are not slowing down, they're accelerating. And when you look at like the revenue and the earnings growth of a lot of these leading companies.
I want you to talk a little bit about, a lot of people go the AI bubble and it's going to burst soon. And they go, you look at NVIDIA and Microsoft and all these other companies that are just investing into each other. You've probably seen like that
Yeah.
image where it just shows all the money. Everyone's just buying into each other. Um, when I look at it, I don't think there's a bubble, I guess, but I don't think it's popping anytime soon, just
Yeah.
because you mentioned this before, and they always do dot-com bubble versus the AI bubble, and they're so different in that one was making no money and the other one is printing money. Can you talk about the differences between companies that are profitable doing CapEx and investing in each other to build an infrastructure and this whole thing that we're actually using versus the dot-com where nothing was, because that is the number one comparison of why people are panicking and freaking out, where they have nothing to do with each other. And, what do you think about that thing of AI bubble popping? What do you think in just, you can just completely make stuff up. Like, what just your opinion on stuff of like, where do you think
Yeah.
it's going to be in 5 years, 10 years, what it looks like? This is us just talking about random AI, the outlook on it.
Well,
Like, how do you feel about all that?
so I think the first thing you have to remember is that it seems like enormous amounts of the world, but you have to remember that US tech runs the technology infrastructure across the world. So when you actually spread that investment out across the rest of the world, it seems much more reasonable. Um, Number two is all these companies, right? Like it was infamous how much cash on hand Apple had and Microsoft and Google. They came into this with like unheard of, unprecedented, historically high levels of immense piles of cash. And I feel like there was points I think that people were like, they have more cash in their balance sheet than the U.S. government has. And you want companies not just having their cash sit in treasuries. If there's opportunities to invest it well, you want that capital invested. Okay. That raises the return on capital invested for the shareholders. That's good for them. So the fact that they found this and they're not just having the cash sit in treasuries is really good for investors. These are not with these, like Oracle is very highly leveraged. So I'm not talking about Oracle, and actually Oracle's not in AOTG. But with the exception of Oracle and CoreWeave and some of these highly leveraged companies, the picture is very good. Now, when you get into companies that are very highly leveraged, like Oracle and CoreWeave, they're operating data centers. A lot of it comes down to how much they're depreciating their chips. And we don't really know how much like the NVIDIA chips of last year when their useful lifespan is over. So if their useful lifespan is 15 years, then that's great. Like they're depreciating it, like, or they're over depreciating it. And if if their useful lifespan is 2 years, they're enormously under depreciating it, and they're not leasing those chips out to their clients at the right price, and they're going to go bankrupt. And so we've seen in the leasing business, like airplanes, people depreciate their airplanes at the wrong rate. They look really profitable, and then the whole business implodes and they go bankrupt. And so you always run that risk in the highly leveraged businesses like Oracle and CoreWeave. And I really think those are areas that might be places where if investors are worried about that, this is an area where they should avoid in tech. But that is not the vast majority of like the tech companies we're talking about. Yeah, there's some other areas in tech too. And like you can't avoid these in market cap indexes, right? But I do in my active fund. So it's another strength of active funds. There's another area like think about like the interest rates, and the Fed started lowering their interest rates 6 months ago. So I took all my interest rate tech companies that are sensitive and tried to remove them from the portfolio. These are companies like PayPal, which is payment processing. These are companies like Paylocity and Paycom, which run HR and and payroll department software. And so what these companies were doing is they're taking their customers' cash and they're putting it in treasuries and earning a yield on it. Okay. And when you actually look at their earnings statements, you realize the vast majority of their earnings actually are coming from interest they're earning on customer deposits. And so like 6 months ago, the interest rates are falling, and you think you do the math and you think, well, interest rates fall 50%, their earnings are going to fall, 100%, so year over year. So you think,
Yeah.
well, it's best to get out of these. And since since the Fed started cutting rates, all these stocks are down like 30 percentage points plus. And so there's some really nice things that you can't avoid in indexes that you can worry about. You don't have to worry about getting in and out of positions with tax effects that you have in a brokerage account, and then you can be very flexible and continue to invest in what has the best earnings growth. So there is like some common sense things you can do to get, even though of a company that quarter showed good earnings growth and good revenue growth, you could foresee in a year that it wasn't going to be there. Another infamous one is like Circle, right? That like takes the stable coin deposits and they invest it in U.S. Treasuries, and like what's that down in 6 months? Like 55%. To me, it was fairly obvious that was coming. The Fed was saying we're going to be cutting interest rates. Donald Trump is like, you guys better cut interest rates. And so like that was a big investment risk that can't be avoided in market cap indexes, but an active fund like AOTG can't avoid.
I never really thought about looking at profitability being like how much is coming from interest rates for some of these companies because they're just putting it
you have to be really
into
nuanced
treasuries.
to be good at this.
Thank you. Now I'm just gonna like add that to another little checklist. I got a lot there. And then you said, I don't know. My brain always thought when NVIDIA they were selling chips, not that they were leasing chips, but they're leasing them on and their lifespans associated with them. Are they 2 years? Are they 15 years? And that changes everything. That's a nice little nuance.
Yeah.
People need to know the difference. Yeah, but that's crazy. That's just another thing to think about when it comes to all that. I don't know if you saw this because you're talking about lower interest rates and how that affects something. Just last night, I couldn't sleep, and I saw that the Federal Reserve head, I don't know what his name is, the guy who does it.
Yeah, that was really sad, by the way. I was like, I feel bad for him. He's not doing anything wrong.
He put out a video being like, I'm being bullied, essentially, and where I'm not going to get bullied. He did like a 1.5 minute video. I'm paraphrasing the whole thing, but it's him being like, I'm doing my best. I've worked under 4 administrations. This is what we do. I'm being bullied right now. Did I take it right?
I mean,
like that.
I'll add my insights on it. And I love talking about these market things. So, all right. So first, I think Trump was right that interest rates should be lower. And he was wrong, right? So I think that's true. But two, it shouldn't result in a criminal probe, right? So I think both of those two things can be true at the same time. I would say Trump was right because the world market is really like a supply and demand thing, and you don't want to try to artificially control where things are to too great of an extent. And so when you have the U.S. rates at 4.5%, and the rest of the developed world is like averaging like 1%, right? Like maybe Japan's 0, Switzerland's 0, but even China, which is way riskier, 2%. Their reserve is charging for interest. And so what you're really doing when you do that is you're making consumers pay higher interest rates on their mortgages, higher interest rates on their cars, higher interest rates on their credit card. And so you're taking, what a 2% difference does on a mortgage. You're taking enormous amounts of cash out of their pocket, and it hurts the economy. And you didn't have to, because our rates were it's clear from what you can see in the rest of the world that the rates were being held artificially high, that inflation was slowing. And you can see when the budget deficit, like we know that when you print money, so the government's spending more than it's taxing, it's just printing the money to make it up. That causes inflation, right? And when the government budget is coming closer to being balanced, though it's not anywhere close to what it should be, that slows inflation. So like there's some common sense things. And by the way, all the other countries knew that too, which is why they lowered theirs and didn't wait necessarily as long as we wanted to wait to see inflation was lower for a longer period of time. So I thought that, it unnecessarily hurt Americans, and Trump knew that pain that it was inflicting and that it didn't have to happen. And so he was angry about it. And I think that's actually for good reason. But at the same time, like I said, just because that guy is not siding with you on a decision that is, somewhat very subjective, does not mean that you should be a target of a criminal probe. And so, that's where I stand on it. But when I think about the long-term future of interest rates, because you guys had near zero rates for a long time too, right? And
it doesn't help though, because then they increase the rates and then everyone.
But when I think about
increase the rates and then everyone's panicking. That's the thing, because now the housing the rates are going to be increasing.
but it's because your deficit keeps growing, so they have to
Sorry,
increase
go
it.
ahead. Sorry, it's
I know
getting
we've got
choppy
a
now.
lag,
Sorry.
so we keep
Yeah.
talking over each other.
Yeah.
But in
Sorry.
person, when we're listening, we're not doing that. Sorry,
Yeah.
in the video. But
Yeah.
basically, it's because Canada can't control their budget deficit, and so basically, investors
Yeah.
have to earn a yield above inflation. And so when you have inflation at and they're printing money, so you have inflation at 4%. Well, no investor is going to give money hypothetically to somebody to be paid less in the future. So like you need to have at least like that
Uh-huh.
barrier set. But if you can have a company that stops printing money, what we have is a very deflationary environment. So what I mean by that is that we don't have a lot of demographic growth, right? So even in Canada, what are people having like 1.2 kids, whatever? It's not, it's
Yeah.
a
Yeah.
shrinking society. And you see that across Japan, you see that across Germany and Italy, right? You see that even in the US. The US is far ahead of you guys. So US kept having a lot of kids in like the 90s while the rest of the world dipped. So we're like 2 or 3 decades behind. But what happens here is you get all these retirees, and think about like imagine if everybody only has one kid. You have 100 million people in a generation, then you have 50 million because they have half the number of kids, and then you have 25 million. Well, in one day, there'll be 25 million workers, and they'll be supporting 50 years of people that are retired, and that might be 100 million people. So you have all these workers who, by the way, are the same people that want to buy a house and buy a car and borrow money. You have all these retirees who have all their money sitting in an account and they want to lend it. So this is a basic mathematic
Yeah.
formula. You have 4 times as many lenders as you have borrowers. How does the market reward that? Well, it makes people lend the money at negative rates. And that's what we saw in Switzerland and Germany and in Canada and in a lot of different places. We saw rates dipping negative at points. Even US got down to 0. And that's because the government wasn't printing so much money that it was fully offsetting that. Now we've seen the budget deficits explode across much of the Western world. And so now they're eating up what that should be. But if the government wasn't eating into the spending so much, we'd all be able to borrow money at close to 0% rates. Because what's happening now is you have more boomers than you have the next generation that is our age, and they want to buy a house and they want to buy a car and they want to borrow money to do it. And so you have a big potential, and it's only going to grow in the future. You have a big imbalance between lenders and borrowers in the market, and that should benefit. And you know what, like how much would Canadians benefit if the government ran a balanced budget and they could all borrow money at negative 1% when they go and buy their house and they buy their car? You wouldn't
Yeah.
see such a crisis in the standard of living, right? And so that it's pretty reasonable
Yeah.
to want to limit the deficit, but also get rates back to where the market should hold them at. And so those are my thoughts on it. And it's just really about trying to have everybody do as well as they possibly can.
While I have you, I want to talk a little bit more about population because you seem to know a lot about this. And how it affects your investing behavior. Because you talked about Canada, you're right. It's I think 1.2. I don't know what the States is, but I'm guessing it's
1.6, I
under
think.
2. It's got to be under 2. Oh, so you
Yeah,
guys
under
are doing a
2.
bit better than us. And as of right now, me and you are populating North America with our children. So it's just like us.
Right.
We're both going over them all.
How
You
many
got
kids do
4.
you have,
I'm
Gary?
gonna have 3. So
3.
I have 2, but my
Yeah.
wife's pregnant with her 3rd. Right?
Well,
Right?
congratulations.
Yeah. So what we're doing our job, right? So like we're covering our bases here. But you Peter Zeihan, that guy, he's always talking about stuff on YouTube.
He's great.
What's his common talk track? It's China's going to fall apart because they have no one. They have no kids. No one. They're underpopulated. They're already past the tipping point. So they're already past that threshold of like how they can repair it. How much of that is, because I've talked to people, I always bring up Peter Zeihan. I just like his content. I don't know. He's really good at engaging his viewers. He's always got something to say. But I've said some people say he's full of it. There's no problem there. Other people going, yep, that's real. I'd like to hear your opinions on the China issue. A lot of people, I'm going to keep just talking a little bit. A lot of people I talk to also say we don't invest in China because there's too much government control on the investments. I don't like the fact that I invest in a Chinese company and the government says nope, and then they just remove that company or they control it. There's too much, right? And there's that real factor. So that's the only reason why they don't go into the Chinese market. That's actually been a reason that I haven't gone in, but I still know how much validity is to that, right? Because I've only sort of talked to guests about it. I haven't talked to someone who's an actual China expert. And then also that issue of population. How does population affect how you invest, right? I took one of your transcripts from an interview, and I think you mentioned something along the lines of in Coca-Cola, Warren Buffett invested in it. But when he invested in Coca-Cola, there's a lot of people to drink that Coca-Cola where you go into the future, it doesn't really work the same way he was investing. When you fast forward 20
Man,
years,
you're
when you
so
just have way
thorough.
less people
You're like
within
my
that age.
favorite YouTuber I've ever met. Yeah.
Okay. I go through everything. Yeah. Okay. So yeah. So can you
Okay.
talk?
So,
I talked about a lot, but just start wherever you want.
all right. So we're going to start with Warren Buffett, and then we're going to go back to how demographics affects investing. Okay. So Warren
Yeah.
Buffett invested in the highest growth possible at the lowest valuation metrics. Okay. And let me point this out. So he went up in the 50s and he bought up all the electric utility companies. And it wasn't because he thought electricity like was going to, be stagnant. He was like, wait, every house is going to have an appliance. There's going to be 10 times as many lights. I see 1000x growth in the US electric market. And so he found that market and then he got the 1000x growth in it. Insurance, he bought up all these insurance companies before insurance was mandated on your mortgage, before it was mandated. It's legally required to have insurance on your car when you drive. It wasn't like that. It was rare when he bought up these companies. So he went from something that served 1% of the population or whatever, like insurance, and he made it go to serving 100%. So this is just tremendous growth. Coca-Cola he grew up, it was a luxury. So people used to think like, oh man, if I have a Coke this week, it's been a really good week. We might go to the soda fountain to have it. Then Coke went to being drank 10 times a day, and not just in America, in the entire world. And so he found these markets with 1000x growth, and he was great at doing it. And also markets that had much higher profit margins, like insurance and Coke and stuff. They were somewhat branded, and so they had much higher profit margins than the traditional industry, though maybe not utilities so much in that sector. But so that's how he did really a fantastic job. And so if you were Warren Buffett today, you'd have to ask yourself, what's going to have the 1000x growth over the next 50 years? And it's really hard to not say software or semiconductors. Like you look into the future and we know we need more software, a lot better software, so we can all automate tasks and do more with less and be more effective and productive in our work and personal lives. And, you come back onto those sectors and you think, well, this is where I should be investing in electronic hardware, things like that. And then the next thing you go to is demographics. Okay. So if there's going to be fewer Americans in 30 years, fewer Germans, fewer Italians, right? How do you think the revenue growth of a water utility is going to be? Negative. We're in we have a fertilizer company, and how do you think we need more fertilizer in 10 years, or do you think we're going to continue to innovate and need less and have less runoff? And that's a good thing, by the way. And so, like, the growth there is negative. We might even need less crops to be planted. And we've actually seen the greening of Europe as like these forests return and they use less of it for farmland. And so there's some obvious trends, but back when Warren Buffett was investing in the 50s, people were having 4 kids. So every 25 years, you saw a doubling of the next population of consumers. So you had, even if people didn't drink it more frequently, you were still going to get 100% growth over 25 years. Now we're looking at some of these societies like China, in the next 25 years, the number of the prime age consumers will shrink by 50%. Because when you count like all the retirees as like population, it kind of masks the population bomb, because these people, like, while they count in the population, they're not innovating, they're not working, they're not really changing the trends. So when you see like the younger age, and that's the population that, 25 years later, there's half the number of them. You see that, whoa, these are the people that are working and innovating. So innovating is going to be cut by 50%. You're going to see, that the number of consumers you have to sell product to is going to be cut by 50%. And it basically makes markets uninvestable. So places like South Korea, think about even like some of their IPOs like Coupang, like just have performed terribly. And it's because there's no growth in those markets. And while it might be minus 50% over the next, 20 years, that's still like minus 2% every year. So it still actually eats significantly into performance on a yearly basis. And so I would never invest money in China, even if it was friendly to the US. you want, maybe you would invest in companies that had products that could scale across the world and serve a lot of people very quickly. But like besides that, you don't want to invest in companies like a regional bank, right? That is going to have half the number of borrowers in 10 years or 20 years. And,
Yeah.
even in pockets of the US, like what's some of the worst pockets of the US, like regional banks in the US, financials really, like those sectors really haven't gone up at all. Yeah, they've definitely gone down compared to inflation once you adjust for that. But in 20 years, and you're like, well, what the heck is that? Well, not only did you have low demographic growth, but you also had people leaving the regional areas and going to the big cities. And so you saw their population in the rural areas or the regional areas actually have been shrinking. And so you saw that not only do you have fewer customers, but you also have lower fees as the market grows more mature and competition becomes more intense for just the remaining number of consumers. And so when you invest, you want to invest in what the data provides, shows that you have the best returns. And demographics, whether it's regionally or worldwide or within countries, is part of that data that you should be using. And like, think about this. The Japanese stock market hasn't gone up since like the 90s, right? Like you see it in the
Yeah.
stock market itself. You see it in the stock market of Italy and France. These countries that are 3 decades above in front of where we are really have seen no appreciation in their stock markets as a whole market cap based index. And so, how do you break that mold that's going to become even more intense over the next 2 decades and continue to succeed as investors? And maybe you can buy a company in Sweden like Spotify that can maybe start in Sweden, but eventually serve the whole world and do it at very high profit margins. And so I think that's, provides even more safety for investors in the long run and is a way to break out of that high risk mold that continues to be forming across the world right now.
One other thing before we head out today, because you've been really generous with your time, I kind of want to touch upon it because I didn't get enough time to research this, but it's back to your funds. I just want to talk about it a little bit, and maybe we can talk about it in a follow-up interview if you come back on the show. That'd be fantastic to have you back on. Is this new one you launched, AOTS? Is that correct, or is it? Did I say it right?
Yeah.
Right?
So it's the
Can
AOT.
you talk about that? Yeah.
So it's the
Talk
AOT
about that. I
software
actually don't know a
platform.
whole lot. Yeah. Yeah.
It's the AOT software platform ETF. And so what this ETF does, the 2 best sectors in the economy, we know this, have been growth and it's been technology. And so I have a growth fund out there. AOTS is my technology fund. And I only really believe in coming out with funds I'm really excited to invest in myself. And that I think give investors a great opportunity to have some of the best capital appreciation in the market. So like you look at a leading market cap based index, like a growth index, and you say, well, these are the ways to improve upon it. And then you look at the tech index and say,
Yeah.
how can I improve upon the tech index? And so what I came back to was I had a low marginal cost filter on top of it. I actually brought in the definition to include common sense tech. To me, those are names, software developing companies like Google and Amazon also, and Visa. And then on top of that, not only do I focus on like the cost of revenue or cost of goods sold to revenue, which is like a low marginal cost filter, but I also screen for things like PE ratio. So I depart from the traditional market cap and also add a factor weighting on top of it, which actually is targeting I've got a value filter on top of it. Because when you think about technology, a lot of people, like you mentioned, are hesitant to invest because they think it comes with higher risk. But I think like they keep thinking of like that NASDAQ that was in 2000 in the dot-com bubble that was just so unprofitable. So what if you could take out all the unprofitable tech? So my index excludes it. And this is a passive index, by the way. It's done, systematically. And in the back test, when you look at that, it actually really raises performance and it also lowers volatility by like a third. So my fund AOTS, compared to like the BlackRock expanded technology software ETF, lowers volatility by almost a third, but also very significantly improves upon performance over the last decade. And so this is about doing what's worked the best historically. And we know that you can depart from, and I know from my research that you can depart from market cap and improve upon the performance of the indexes. So I think if I could come out with a better technology index for people to invest in, it's going to prove itself to the market, it's going to take 5 or 10 years, but I'm willing to be there for the long run and show that this index has the potential to do that. Nobody can guarantee the future, but I'm invested in it. I'm very excited about it. And I think with time, it has the potential to prove to be the best technology index ever made.
And that's new, right? That's fairly new.
Yeah,
That like,
December
or last year
2025.
you launched? Because
It's been,
that's why, yeah. Because I was
yeah,
doing
2
research
weeks,
on
3 weeks.
what was the comparable? So when people are just, cause like people like to do side by sides. I mentioned SP MO for AOTG just because that kept coming up. Was that BlackRock index the one that people probably be
Yeah,
looking
I
at when
like
they
to
do
compare
side
it to
by sides?
IGV. To IGV.
Okay, all
Um,
right.
but I mean, I think you can compare it to a technology, to like any technology index as well. Just understand that it's a little more software based than it is like semiconductor based. So you will be underweight the
Okay,
semiconductors and overweight the software because it focuses on that software platform sector that I created just for this index because I thought it was a better definition of that low marginal cost technology that I think investors benefit from targeting. And I think like investors, historically, I don't think they do this. The average investor allocates any portion of their portfolio to technology. Now, I think it's quite common for investors to allocate part of their portfolio to growth, but I want to I want to target technology in my own investments. I know AOTG already has a technology exposure, but I thought that there's a way to do this in a passive based index that just really provides value and improves upon the existing ones. And it's when you see like a hole like that in the market, you think whether it's like you're targeting low marginal cost businesses or improving upon a technology index, if you can use your ideas to help people do better and have a better future, that is like one of the most satisfying things I can do. So I'm happy to have AOTS out there, and I really hope it does that for people.
that's great, John. All right, it was fantastic talking with you. I love what you're doing over at AOT Invest. Obviously, I'm a big fan of how you built AOTG. I think it's a fantastic fund. Yeah, it's just great. So thank you for jumping on with me today. I really appreciate it, and I'm sure we will talk very, very soon.
Thank you so much, Gary. It's a pleasure to be here and